Hi, I'm Rupert Schofield, President and CEO of Think International, the microfinance network, and host of the Social Enterprise Podcast. We have a real interesting show for you today, a real star-studded lineup. We have Stephanie Turpin from
FHI 360.
FHI. We have Brian Vo from PACT. We have Chris Walker from Mercy Corps. Um, we're going to talk, well, you guys can say hello and give your title if you don't mind. Stephanie?
I'm Stephanie Turpin. I lead the Strategic Partnerships team at FHI 360.
Brian Vo, I lead the PAC Ventures team at PAC.
And hi, Chris Walker with Mercy Corps Ventures.
Okay. Now, I'm sure you're wondering, what do these interesting, impressive people have in common? Well, we're all working in the impact investing space, but we're kind of doing it in different ways. And so we'll kick off today with my guest describing what their organization does in the impact investing space, what approach they take, and how does it maybe distinguish them, differentiate them from others. So Stephanie, why don't you kick it off for us?
Sure. So I work for FHI 360. We're a global development nonprofit working in global health, education, the future of work, and advancing social equity in the United States, among other areas. So with such a broad mission, impact investing and innovative financing are really critical to us in developing the kind of capital and partnerships that we need to solve those big, hairy social problems. So we have a subsidiary, a for-profit subsidiary called FHI Ventures, which houses our impact investing work and makes investments in early stage companies that are aligned with our mission. We invest through debt and equity and also provide technical assistance through an accelerator program, some mentorship, and just connections with our programs and projects around the world. We've now made 9 investments and are still, frankly, fairly early stage in our thinking about what this means for our business model and for the way that FHI 360 does its work in the world. So lots to talk about and lots for us to continue to learn.
Very, very interesting. And you're in the U.S. and overseas, is that right?
Yes, we are. Yes.
How's it break out? How many U.S., how many developing
In terms of the
countries?
companies? Right now, our first cohort was entirely companies that were based in the United States but working in emerging markets. And now in our second cohort, we've incorporated more companies that are based in the markets where they actually work. But we don't have any companies right now that are working in the United States. Right now, that work is entirely grant funded or funded through other types of corporate partnerships.
Great, thank you. Okay, Brian?
So PACT, also a global development organization, some of the impact areas of focus, health, especially around HIV mitigation, livelihoods, especially financial inclusion, increasingly natural resource management, energy, and artisanal small-scale mining. Cutting across those, couple major disciplines would be our capacity development practice and our governance practice. And so I think the way we think about development, trying to tie all of those impact areas together is to look at solutions from a systemic perspective, because it's hard to really move the needle on a community if you're not addressing some or all of those elements of daily life. Over the last 5-10 years, with the growth of impact capital, we started asking, what role can a development organization play with or through that type of money? And so that's where PAC Ventures was started. And so I think the way we think about what's the value that we can bring to PACT as a development organization, but also to our beneficiaries around the world, really shakes out into 3 themes. One is working with our technical teams to take some of the private sector skills the teams built over a career prior to development, and seeing how we can bake in innovative financing mechanisms, behavior change mechanisms, incentive structures into our programs and our projects. Second major one is looking at partnerships. So we know we can't do everything by ourselves.
You figured that out too?
Yeah, right. So in that ecosystem, are there other people who have the product or service or solution that we need? And then classically take a buy build partner view of it, and for things that we can't build or don't have the money to buy, can we partner to connect that to some of the efforts that we have. And then lastly is that buy part, right? So doing strategic investments in early stage companies, but very much from the lens of the financial and social return, but most importantly, what's the strategic value that that organization or company brings to the way we think about our theory of change. And so in an early investment, and this is where we've co-invested with Finca Ventures, the reason we did something like an ant was to help build up our energy practice or components of it, right? So it all comes back to Pack's theory of change, and how can we deliver that better, faster, cheaper.
Okay, thanks, Brian. And you brought it up. We are actually partnering ourselves. Brian mentioned our amped innovation in the energy sector. And then Stephanie, I think we are in the in the dirty handling business of water with Sanovation. Also a really interesting company. Chris, we haven't gotten to you yet, but we will. Don't worry.
Oh, that's fine.
Anyway, why don't you tell us about about Mercy Corps? How did you guys come to impact it?
Yeah, absolutely. So as background, Mercy Corps is also a global nonprofit. We focus on humanitarian work as well as long-term economic development in over 40 countries around the world. We have worked closely with communities to help them solve their own problems. And as you mentioned, for years we've been involved in market-based approaches, including supporting the microfinance sector. And we've always seen that entrepreneurs are a key part of solving problems. Entrepreneurs are nothing if not problem solvers. And we wanted to find ways to better engage with social entrepreneurs to help us solve the complex challenges that we care about and that we're focused on as an organization. So about 4 years ago, we started our early stage venture investment fund called Mercy Corps Ventures. We invested at seed stage in private for-profit businesses in several developing countries that are addressing the problems that Mercy Corps cares about. So we've been focused on companies that are operating in agriculture, in last mile distribution of socially beneficial products and services, in youth employment, and in financial inclusion. To date, we've made almost 20 investments, and we're looking for ways to continue to expand our work because we see that entrepreneurs are so key to solving these complex problems.
Wonderful. Now, I'm sure you're all wondering, well, how about Finca? How did Finca get into this? And so with your patience, I'll just do a little rap here myself. I actually began thinking about the limitations of microfinance a couple of years back, but what really drove it home to me was we had a spectacularly successful client in Uganda, a woman named Naima, who you all know these stories, people who are, they're literally destitute, they've got families, and then suddenly they come in contact with a village bank or something, they get a little capital, and they're just born entrepreneurs, and they just take off. So this woman had built this wonderful restaurant in Jinji, Uganda. She had advanced to the point where all her kids were in university. She had bought some land, she was building a house, and and she was just doing spectacularly. But one time when I visited Uganda about 10 years later, I asked about her, and they said, oh, it's a terrible story. She got breast cancer. She fell into the hands of some unscrupulous doctor who misled her, took all her money, mangled her and everything. Sadly, she eventually died of breast cancer. And I thought, wow, if this can happen to our best client, then we need to somehow do more. And I thought about let's partner with social enterprises in healthcare and ag and water and sanitation and education. So that's how we're approaching it. And it's a fascinating road. It's not an easy road, but I don't know about you guys. Is it just me, or are there just tons more social enterprises popping up than there ever were in all these sectors, giving us the chance to really leverage our work through them, through partnering with them? And doesn't it feel like kind of a second revolution that's kind of taking place here? What do you think,
It does. I mean, it feels like our sector is changing so much. You know, when we think about how impact is happening, it's not just nonprofits, it's for-profits, there's now investors in addition to donors. And I think that gives some of us who've been in the sector for a while sometimes a bit of angst that, you know, things are changing and we don't completely understand how. But I think there's a huge opportunity in that to partner differently, to work differently, to find different types of capital. And that's, you know, something that I think is really interesting about FHI's journey, that, you know, we have started spinning off subsidiaries as ways to operate differently in these new markets. So we now have subsidiaries that are focused on partnering with corporations, a subsidiary that takes a commercial approach to clinical research, a subsidiary that I mentioned, FHI Ventures, that's working with social enterprises and social entrepreneurs, a private foundation, one that's focused on nutrition. And so I think through all of these kind of little experiments of different organizational forms, we're just in this process of business model experimentation to figure out what's going to work for us and where our fastest pathways are to the change that we're seeking. So the organizational form can be different. It can be for-profit, nonprofit, capital can have different expectations, but I think what's important is that we keep our eye on, you know, what is the change that we're trying to make, and how do we bring all of these different resources together differently to make that happen faster.
Mm-hmm. How about you, Brian? Was that a sufficiently leading question? A simple answer.
Yeah, I think that was really well said, and just to continue that stream of thought, I think it's one where it's just the convergence of sectors, right? And I think it's the shedding of labels and stereotypes to really get down to the root cause, the root problem of, like, what are we trying to solve, and who has what asset, skill, or perspective to be able to solve that, irrespective of if your tax status is 501 or, you know, taxable, regardless of whether you're incorporated in, you know, Uganda or DC. And so I think it's interesting because I think a lot of the solutions that we're all trying to innovate, there's still a little bit of catch up from, you know, the regulatory bodies, right, and even from the IRS. They're putting out a lot of guidance on to help enable some of this stuff, but it hasn't fully quite caught up, right? So some of the things that we're working on, you know, where it's developing we've already developed the infrastructure for HIV mitigation in the country. That country also experiences high rates of cervical cancer. And so the Ministry of Health wants to do a big HPV vaccination program. We're now in the middle of trying to structure what would look and smell like an impact bond, bringing in you know, a major vaccine provider who would then tier the rates of the vaccine based on our success of how many people were getting vaccinated. But the hardest part of the structuring has been how do we remain compliant with donor regulations, USG rules, and also that local country's tax rules. And on top of that, the multi-stakeholder negotiation of trying to get, you know, work through local country, you know, government procurement processes, and that innovation is just, it takes longer.
Mm-hmm. I see the nodding, and I'm nodding myself. I see another apex organization be in formulation at some point. How about the Mercy Corps?
Yeah, and just coming back to your question around, are we seeing this upsurge in social entrepreneurs these days? And I think that looking at more of the historical arc here, for decades investors have been looking at ways in which, recognizing that businesses play a role in society, for good and for bad, to help push business more towards a positive path in terms of impact, or at least, you know, not making sure that businesses don't have too much of a negative impact on society. But we are seeing a lot more, especially young people, get into this sector, saying, well, actually, I think not only can I make sure that business is not doing just bad stuff, but we can actually use business practices as a force for good. And I can set up a business, run it for profit, but also deliver positive social or environmental impact at the same time. And we welcome that because the challenges that we're facing are so complex, it should be all hands on deck. We're very good as a nonprofit at working with civil society organizations. We're very good at working with governments. All of those are crucial actors in solving these problems. We should also be working with entrepreneurs as part of that. If you leave them out of the equation, you don't have a chance of solving these complex challenges. So we have been, as an organization, just kind of in our DNA to work in a more entrepreneurial, market-based way. So finding ways in which we can engage with private sector actors is just part of how we operate. In our venture fund now is another tool that we have to better engage with entrepreneurs.
Mm-hmm. So do you see the day coming when every business is going to have to be a social enterprise, or nobody's going to want to work for it or buy anything from it?
This is a great question. Everybody has different motivations, but I don't know about you guys, but we have definitely seen just through personal networks, more and more people coming through policy school, through business school, graduating from university, wanting to make a positive difference in the world and work for a business at the same time. So there's certainly, I think, more and more pressure on businesses to offer a compelling social or environmental reason to come work for them. If you want to attract good talent, the good talent that we're seeing wants to make sure that they're having a positive impact on this world.
Mm-hmm.
And so if you're a social entrepreneur, you are in a position now to attract some really talented people coming into the working world.
Mm-hmm.
And it's not just talent, it's investment capital, it's customers. I think many different groups are getting more sophisticated in how they think about the impact that businesses have. So, will every company be a social enterprise? That might be a bit of a stretch because some products and services are inherently unsustainable and yet critical to the way our world operates right now. I'm thinking of the extractive industry as one example. But even in those companies, I think we're seeing more and more sophistication in how they talk about how they're mitigating the difficult parts of their business and creating some social good in other areas. So just that evolution of how companies build their businesses and talk about their businesses, I think is going to be critical for every company, just for customer acquisition.
Mm-hmm.
And we're certainly seeing a trend in the financial sector and the investment industry that some of the biggest, most commercially oriented players in the financial services are now starting their own impact investment funds. And it's because their customers are demanding it.
Mm-hmm.
And a big customer base for a lot of these companies now is the millennial generation. It's inheriting a huge amount of wealth and broadly looks for social impact through their investments. And so, BlackRock and Goldman Sachs and KKR, they're seeing this trend and they need to respond to their customer demand. So they are setting up these impact investing functions. It's a hopeful trend. There's still a lot of work that needs to be done to ensure that as more and more money comes into this sector, that it's actually delivering impact.
And I don't know if this would be poking the capitalism bear too much, but I'd actually reframe it to say,
He started it.
will businesses revert or go back to being social enterprises, right? I think the phenomenon that we've been seeing over the last 60 odd years has really only been, well, at least that point, like in that 60 years. Prior to that, and prior to Friedman's maximizing shareholder wealth, which also needs to be placed into context, I think one would argue that businesses were operating with social intent and community intent, and I think it's because of some of the perversion of unregulated elements of capitalism and markets, and you can see, especially financial crisis and post-financial crisis reactions in this country, a slow move back to shouldn't business be held to a higher standard than just shareholder maximization.
Mm-hmm. Okay, now's the moment for my Larry King type question. Doing well while doing good? Possible? Think about this before you answer, but think about when times are not good and you start losing money in the social impact fund. Possible or not?
Possible, yes, of course. I think we've seen so many examples of this. Always essential? I don't know that that's necessarily the case. I think one great example that we have from the INGO sector's involvement in impact investing is this understanding that sometimes there do need to be trade-offs in order to have higher impact investments. And so we're seeing in the INGO sector that frequently many of us are investing in harder to reach markets, smaller, earlier stage companies, companies that are giving lower returns, companies that need more technical assistance, which drags on the cost of operating the investment model. All of these things are a specific value proposition that I think social sector organizations can add to the impact investing movement. We're showing that you can make investments in this space that do have returns, that can be sustainable, and showing that that can be part of the overall, big tent of impact investing. So when I say doing well by doing good, yes, we are an impact first investor and we're targeting market rate returns. But, I think there are ways that we can talk about where there might be smart trade-offs in order to kind of dial up the impact, even if we do have to take some kind of hit on the returns, and make that a real use case for other investors who are looking for examples of what that can look like.
Let's hear from the capitalist bear.
I absolutely agree. I think what I struggle with is the framing of it to begin with. I don't think I remember in business school in ethics class when we got to the Milton Friedman conversation, shareholder maximization on one side of the room, shareholder maximization on the other, and then line up where you think you're on the spectrum. And I thought that just self-perpetuated this idea that those two goals are dichotomous or even mutually exclusive. I think what we're really seeing that's so inspiring from a lot of the social entrepreneurs that we're working with in these countries is it's challenging how the product and service design model from the private sector, how it's designed products for markets that are not middle income or markets that are not in developed countries. And I think where you go back to basics and you think about what is a consumer need here in this geography or this context, and you solve for that, then that you don't have that dichotomy of doing well or doing good. You're serving a customer, and what is their need. I think where I think the developed world has that conversation, and we're stuck a little bit is that the products and services previously that have been designed feel like they've been taken from for highly profitable markets, whether it's developed countries or middle to upper middle income type of products, and then repackaged it, tried to make the COGS cheaper, made it with questionable labor practices, right? Just tried to strip it down and then say, oh, hey, here's the product for an emerging market. But that's hopefully this isn't too crass, but that's a bit of a lazy way to design product for customers, and I think that's slowly emerging.
Mm-hmm.
Just to pick up on that theme around serving customers, and Jacqueline Novogratz, who founded Acumen, which is one of the pioneers in impact investing, often talks about the market as being a great listening device. That when you are an entrepreneur trying to sell a product or a service to a customer, you're only going to succeed as a business if you're actually providing something of value. And that transaction that occurs between you, the business, selling something to the customer means that you're getting feedback from that customer on whether what you're offering is of value to them or not. So this model of being a social entrepreneur trying to sell something, you will do well if you are serving the customer's needs. We at Mercy Corps, we're trying to invest in really early stage entrepreneurs who are trying to pioneer new markets. So I think your question, can you do well by doing good? When these entrepreneurs are trying to create and pioneer new markets, create new products that have never been seen before, new service offerings to reach customers that have never had that service before. I think the jury's still out on whether those businesses will thrive or not. We're taking a bet on them because the promise is so potentially impactful, and we feel it's worth taking that bet and it's supporting them to see if that happens or not. And even if they fail, we can learn quite a lot about whether the market is ready for this or not, and what works and what doesn't. And hopefully that knowledge filters back into our other work in trying to reach underserved communities and help them solve their own problems.
Yeah, thanks, Chris. So speaking for Finca, if you had asked me in like 2011, can you do well and do good at the same time? I would say absolutely. Yeah, emerging markets, no sweat. We've worked there a while. We've learned it. We've learned how to do that. And then comes 2015, and oil prices tank, currencies tank. We get smashed. Our profitability is just, across every one of our oil producers, but also other commodities. And suddenly, oh wow, this really is different. We weathered 2008 fine. I was like, yeah, we're awesome. The entire financial system can collapse. Frank is still here, yay. So I have a new view now. If you are determined to work in Afghanistan and Pakistan and the DRC, guess what? It's not going to be, the hockey stick, the perennial rising hockey stick. No, I don't think it can be done anymore. And so I think you have to vet your investors a very different way. Say, yeah, I know you're an impact investor, but are you really going to be patient when things go south? Or are you going to cut and run and say, I want my money back now, liquidate it? Anyway,
Yeah.
don't get me started.
Right. Well, it's a good point because that hockey stick construct of growth comes out of Silicon Valley tech companies.
Yeah.
And in the markets in which we operate, that it's totally different conditions. The private sector plays an important role. We see companies growing, but you're probably not going to see that growth path. And so the way in which we invest in those companies and the way we think about investing needs to be different as well. And I can certainly comment on, to get in a bit of the weeds about how we invest, the capital that we utilize, so we're investing equity or convertible debt at a seed stage round, a very early stage company. So, our exit opportunity, our chance to make money off of that is going to come well into the future once that company has grown, once other investors come in and there's some exit opportunity for us. Because of the growth pattern of these companies, because of the markets in which they operate, I think you do have to be even more patient there. We use philanthropic capital, grants made to us by foundations, by high net worth individuals to invest. That means that we can be very patient in looking for that exit opportunity. We can be with these companies through the ups and downs of their growth path in these markets, and there is certainly a lot of those ups and downs.
Do you guys also use you're talking blended finance, I think is the term, right? First loss tranche and stuff like that. Do you guys do blended finance, or would you say it's more conventional?
Yeah, we have the same philanthropic capital. So back to my point about the FHI 360 family of companies. Back in the 90s, we sold a couple of clinical research organizations and endowed our own foundation. And now that foundation has put the startup capital into FHI Ventures for its first 9 investments. However, we're using this as a period where we have this philanthropic capital, where we have more freedom to really test our investment thesis and make sure that we can prove that you can get market rate returns from these type of investments so that we can raise other types of capital in the future.
Yeah, our blended finance comes more in the creative, innovative financing stuff that we're doing. So I think there's one example where our mining technical team came up with this idea where, if we deployed this intervention, we think it would help artisanal female miners get better transparency on pricing and valuation of the stones that they were trying to sell. So just an idea, right? And so Peck Ventures put down 50,000 to pilot this with a bunch of partners across the value chain. And the structure that we had going in was, while it was unrestricted off of our balance sheet, we essentially tried to structure it in a way where it was PRI-like, where forgivable loan. And so for our partners, if and when this becomes, becomes a bigger thing, profitable and self-sustainable in itself, we have a first lien on the cash flows coming out until we're repaid to a certain threshold. And then if it doesn't, the hope is we would have created a good body of evidence from that pilot to be able to shop it around to donors and say, look, this is inherently not a self-sustainable model, or at least in the current construct. So it requires donor capital. And so if that 50K yields, a 10 mil donor project, I'd be just as happy. But it gives us a little bit of flexibility to create the solution and then figure out what's the best revenue stream for it.
Okay. I think you kind of led with your kind of hypothesis, or I think you put it theory of change, but I didn't get so much from you two guys. Stephanie, is there a big hypothesis you're trying to prove to the world and say, okay, we've cracked the code, now give us, the capital?
A hypothesis we're trying to prove to the world. I think the hypothesis is more what we're trying to prove to ourselves and to our sector. So FHI is really known for high quality research and best practice, excellent implementation in global development. I think we all know that a large established organization in a mature market is not necessarily the most fertile bed for innovation and for new approaches. And so for us, part of the value prop of FHI Ventures to us as an organization is a really cost-effective way to access new ways of thinking, new ways of working that are advancing the same type of impact that our grant-funded work is trying to access. And so the fact that we have mentoring relationships with our investee companies is partly for them and partly for us, because we want to work closely with them so that we can understand how they're thinking about these problems and how they're proposing solutions, and then loop that back into our projects and to our work. So, the question we're trying to answer is, what is the best way for FHI to solve these problems?
Mm-hmm.
Who are the partners? What are the capital? What are the approaches? What are the new technologies? So I think that's, an open question for us as an organization, and I would say, broadly for our sector, our little family of peer organizations that are constituted as these large nonprofits and sometimes, feel like dinosaurs in this world that's being super disrupted in terms of who the actors are.
Yeah, our hypothesis going in with our venture approach was that a global NGO has value to add to entrepreneurs as they grow beyond capital. So obviously our entry point is capital, that we can address the financing constraint that so many early stage entrepreneurs in developing markets are facing. They struggle to get that really risky, risk-taking early stage capital. We can come in and help fill that gap in the investment spectrum. But why is an NGO doing this? We feel that we have some value to add, and that's what we're trying to prove out. What is it exactly that we offer as a nonprofit compared to other impact investors that's of value to these entrepreneurs as they try to grow and succeed in the markets in which they're in? And that's what we've been testing out. We found to date, what do we have? Well, we have over 5,000 people on the ground in over 40 countries. Almost all of our staff are from the places in which they work. So they have incredible local knowledge, they know the context, they have great local networks, they have technical expertise. All of those things are of value to entrepreneurs that are looking to expand their market and better understand the customers that they're trying to serve. We have built a post-investment support unit that can provide some technical support to companies that we've already invested in to help them on their growth path and to tap into these resources that Mercy Corps has. And we've also been helpful in terms of making introductions to other investors, to global organizations that can be beneficial to these companies. And we utilize that to the best ability that we have. So it's this, what exactly works that we have to offer. I think we also went into this thinking, we run a lot of development programs and projects, and those should be beneficial as well to entrepreneurs. And there's a lot of nuance there around what works and what doesn't between connecting your development projects with what an entrepreneur is trying to do. We've had some success in that area. That's been a challenge to make that connection. But what we've realized is all these other assets that we have, these contacts and networks and technical expertise, is incredibly valued to the point that entrepreneurs are coming to us saying, we want Mercy Corps to invest in us in addition to other more traditional investors because we see these values. We see, we know your local staff and they have great expertise. We'd love to have access to them more frequently. We know that you have these organizations in your network. We love introductions to them as an investor. So it's things like that that are emerging as valuable.
Do you guys still have a microfinance network as well?
We do. We are not as active in, I think starting about 2 decades ago, we had been very active in helping to set up microfinance institutions in countries and in regions of countries that were really underserved by microfinance. We still have ownership stakes. I think about a half dozen plus microfinance institutions where we continue to sit on the board and provide oversight and strategic direction. But our work in financial inclusion has broadened out beyond support of microfinance institutions. We're looking at more financial technology now that can reach underserved people. And we're investing in that through our venture fund.
Are any of those financial MFIs, I guess they would be, I'm not sure, we went the route of banks, and that's had its ups and downs. But do any of your MFIs actually finance any of these investees you've got?
No, and it's an important point. So there are obviously many types of businesses in the countries in which we work. And we have decided with our investment work with Mercy Corps Ventures to invest in high growth, scalable businesses with equity. There are a huge number of small and medium-sized businesses that play incredibly valuable roles in their communities. But that's not an area where we feel very strong, where we can provide a lot of support. We don't do debt financing, for instance, with Mercy Corps Ventures. And a lot of these smaller businesses are looking for debt rather than equity. We don't have those extensive networks with, say, agribusinesses, smaller agribusinesses in the countries in which we work. It's just not a strength of ours. Whereas we do feel that we have value to add to entrepreneurs who started a business with a view of scaling nationally, regionally, globally, and that have those solutions that are applicable to many people so that we can achieve high impact through support of those companies. So I think that's the differentiation. We see a lot of microfinance institutions playing an incredibly valuable role in the capital spectrum of investing in smaller businesses. But our ventures arm invests in this much smaller set of companies, but those that are high growth.
What about collaboration? What do you think people like us could do? We are doing collaboration. We're investing together. Is there more we could do to leverage our power as some of these seasoned players with tons of experience, as you mentioned? What do you think?
I think one thing I've been really impressed about from the impact investing groups at INGOs is how connected and transparent they have been. We have been. We have a network of INGOs and impact investing convened by Humentum and the Aspen Network for Development Entrepreneurs. And within that network, people have been really wonderful and just transparently sharing their approaches, what's working, what's not working, their investment pipeline. We've seen some co-investments, which has been really wonderful. So I think that collaboration, to my mind, is there and is working. What I would love to see more in terms of partnerships is cross-sectoral partnerships. So to Chris's point from earlier about some of these big Wall Street banks that are making moves in impact investing, they have enormous amounts of capital. And we as INGOs have some really interesting investment approaches, some hard-fought lessons learned, but frankly, fairly, relatively small amounts of capital so far. I would be really fascinated to see if we could find some partnerships there that could help leverage some larger dollar amounts for some of these higher impact investments that our sector now has experience making, but not as much money behind.
Goldman, you listening? I hope so.
Yeah, I think all well said. On the investment side, it's part of our strategy and approach that we are never the sole investor, nor are we the lead investor. So we will only do co-investments as part of a consortium where somebody else is lead investor. And so I think, and that's helped us be really transparent. I think what would excite me is being able to tap into the capabilities, products, services of the other parts of our houses, right? And so one thing that PAC just doesn't have and has to partner on with our HIV work is clinical. So we'll partner with stronger clinical organizations. And so, is beyond how we're blending finance and blending investment, can we do more to, can that help us in creative financing, help us blend our solutions? Looking at MFI as your assets on the ground, is that, depending on the geography, is that somewhere where some of our financial literacy content could help cultivate a market and drive it towards a FINCA MFI, something like that, right? Across a few other issues. That would be really exciting for me.
Terrific, Chris.
Yeah, I mean, I see impact investing as inherently collaborative. We have to find companies to invest into, so we're collaborating with incubators, with accelerators, with later stage investors who are approached by entrepreneurs whose investment needs are too early for them. Like PACT, we only co-invest. So we're always collaborating with other investors. We're sharing our deal flow, our leads with others. Right now, we're only investing at the seed stage. We're not following on, so we're also helping the entrepreneurs make contact with other investors to come in at a later stage. And I mentioned as well that we provide a lot of support to entrepreneurs after we invest in them. Some of that is delivered by our own staff, where we have that technical expertise, but the business needs of companies are so broad that there's no way we can have all that in-house expertise. So we're using our networks to bring in other organizations to provide support, whether it's on financial management or on technology needs or on branding and marketing. So we're always reaching out to our networks, collaborating with other organizations to provide that kind of support.
Well said, Chris. Well, folks, I'm afraid we're at full time, as we'd say on the football pitch. Stephanie, Brian, Chris, brilliant job. Thank you so much. Tell us how we can get in touch with you.
Sure, you can take a look at FHI 360's website at www.fhi360.org. And we're on all the social media channels as well.
For PACT, you can visit our website at pactworld.org, LinkedIn and Twitter, also at PACtWorld.
And you can reach us as well on our website, www.mercycorps.org. Look for ventures on there. We are coming out in the next month with our next annual impact report, so you can read a lot more about us as well as in our previous impact reports.
Thanks, Chris. You can find a copy of this podcast at sokentpodcast.org. You can find me at Rupert Schofield on Twitter or at finca.org.